What is happening, crypto champions? Get ready, because the news cycle is absolutely on fire today, and you're about to get the inside scoop on moves that could redefine the market. We're diving deep into the strategies of the biggest players, uncovering shifts in digital assets that are turning heads, and dissecting the forces that could send us soaring. From massive accumulations to surprising outperformance, you won't want to miss a single second of this action-packed update. Stick around because this is Bitcoin Bulletin, and we're bringing you the unmissable stories shaping tomorrow, right now. First up, a colossal whale is making waves, quietly expanding their digital treasure chest. We're talking about a significant addition to an already massive Bitcoin hoard, a move that's got everyone watching. What does this mean for the market's stability and future trajectory? We've got the details. Then, we're shifting gears to explore the broader narrative of institutionalization and the powerful macroeconomic currents that are setting the stage for a potentially explosive 2025. This isn't just about one asset, it's about the entire ecosystem being supercharged. But wait, there's more. When the market gets choppy, where do the smart money and the risk-averse flock? We're uncovering the surprising outperformance of a specific type of crypto asset that's shining bright amidst the turmoil, offering stability and incredible returns. Finally, we're breaking down the critical signals from the financial world's biggest players, the Fed, and what their next move could mean for your portfolio. Are rate cuts on the horizon, and what risks are lurking beneath the surface? We're covering it all. You need to know this stuff. Make sure you're subscribed, hit that notification bell, and let's get into it. A whale's big move, 200 BTC added. In a significant display of conviction, a major Bitcoin whale has dramatically expanded its holdings, acquiring an additional 200 BTC through the institutional trading platform FalconX. This strategic accumulation brings the whale's total Bitcoin reserves to an impressive 2,419 BTC. A staggering stash currently valued at approximately $265.9 million. This on-chain transaction, meticulously tracked by monitoring tools, underscores a clear intent for strategic accumulation by one of the market's largest players. The address, BC1 QGFQHL6 Edwixutlfmemsel 0 QTZPISC 86JN02 SV, is now under the spotlight as this whale continues to build its position. This substantial acquisition occurs against a backdrop of heightened whale activity observed throughout the second quarter of 2025. During this period, the market has witnessed a notable trend of significant Bitcoin holders actively converting their BTC into Ethereum ETH and executing large-scale liquidations. This dynamic reshuffling of assets is actively reshaping the liquidity landscape across major cryptocurrencies. The whale's decision to increase its Bitcoin holdings, rather than participate in the BTC to ETH conversion trend, signals a distinct strategy and a potential divergence in sentiment among major market participants. FalconX's role in facilitating this massive transaction highlights the increasing reliance on institutional-grade platforms for executing large-volume digital asset trades. These platforms offer crucial advantages in terms of secure custody, efficient trade execution, and cost optimization, making them indispensable for whales managing substantial portfolios. The choice of FalconX suggests a preference for a professional and reliable infrastructure to manage such significant capital movements. This accumulation by a major whale could have tangible impacts on Bitcoin's market dynamics. Large-scale purchases can reduce the available supply of Bitcoin on exchanges, potentially bolstering price support and enhancing its resilience in the spot market. Market observers are closely watching to see if this move signals a broader trend of accumulation among large holders, which could lead to increased volatility, especially given the recent uptick in trading volumes following similar whale purchases. Meanwhile, Ethereum has also been a focal point for whale activity, with substantial inflows and conversions from Bitcoin. Reports indicate that one whale, previously holding over 100,000 BTC, liquidated a $2.7 billion position to acquire 62,914 ETH, while another converted 24,000 BTC into 416,598 ETH, and staked an additional 275,500 ETH. Collectively, Ethereum whale wallets saw an influx of 200,000 ETH, equivalent to $515 million, in Q2 2025 alone. These actions are often attributed to Ethereum's inherent structural advantages, including its deflationary tokenomics, attractive staking yields averaging 3.8%, and the impact of recent network upgrades like the Dencun hard fork. Furthermore, the U.S. Securities and Exchange Commission's SEC reclassification of Ethereum as a utility token has significantly boosted institutional interest, with prominent entities like Harvard University and SharpLink reportedly treating ETH as a strategic reserve asset. Despite the considerable capital flow towards Ethereum, this latest Bitcoin acquisition by the whale underscores the persistent demand for Bitcoin as a macroeconomic hedge. The timing of this accumulation aligns with anticipation surrounding potential U.S. Federal Reserve rate cuts and the evolving regulatory landscape in the United States. The whale's strategy appears to be a calculated balance between long-term value preservation and active liquidity management, leveraging platforms like FalconX to achieve these objectives. As the cryptocurrency market continues to mature, institutional investors are increasingly adopting a diversified approach, allocating the majority of their capital to Bitcoin for its stability and perceived role as a digital store of value, while allocating a portion to Ethereum for its growth potential and technological advancements. The ETH-BTC ratio, reaching a 14-month high of 0.71 in Q3 2025, reflects Ethereum's growing appeal. However, sustained inflows from significant holders like this whale reaffirm Bitcoin's foundational status in the digital economy, reinforcing a market narrative where macroeconomic trends and regulatory clarity are pivotal in shaping investment strategies. But what does this mean for the broader institutional adoption and the economic forces at play? Get ready to dive into the macroeconomic tailwinds that could be fueling a self-sustaining bullish cycle for 2025. 2025 Bull Run, Institutionalization Meets Macro Tailwinds. The cryptocurrency market is on the cusp of a potentially transformative year in 2025, driven by a powerful confluence of increasing institutional adoption and favorable macroeconomic conditions. This dynamic interplay is creating what analysts are calling a self-sustaining bullish cycle, where each positive development reinforces the next, creating upward momentum for digital assets, particularly Bitcoin. The narrative of Bitcoin's institutionalization has been building momentum for years, and 2025 is shaping up to be a pivotal year. The approval and subsequent performance of spot Bitcoin exchange-traded funds, ETFs, in the United States have been a game-changer. These financial products have opened the doors for a broader range of investors, including institutional asset managers, pension funds, and even retail investors seeking a regulated and accessible way to gain exposure to Bitcoin. The consistent inflows into these ETFs, despite short-term market fluctuations, demonstrate a growing appetite for Bitcoin as a legitimate asset class and a hedge against inflation and traditional market volatility. Major financial institutions are not only offering these products, but are also increasingly engaging with the underlying technology, exploring blockchain solutions for various applications, further legitimizing the digital asset space. Complementing this institutional surge are significant macroeconomic tailwinds. Expectations of potential interest rate cuts by the U.S. Federal Reserve in 2025 are a major catalyst. Lower interest rates typically reduce the attractiveness of traditional fixed-income investments, pushing capital towards higher-yielding or growth-oriented assets, including cryptocurrencies. As borrowing costs decrease, companies may find it cheaper to raise capital, potentially fueling innovation and investment in the tech sector, which often correlates with digital asset performance. Furthermore, ongoing geopolitical uncertainties and persistent inflation concerns continue to bolster the appeal of Bitcoin as a digital gold, a store of value that is decentralized and not subject to the monetary policies of any single nation. The synergy between institutional adoption and these macroeconomic factors is creating a virtuous cycle. Increased institutional demand drives up liquidity and price stability, making Bitcoin more attractive to a wider audience. This, in turn, attracts more institutional capital, further solidifying Bitcoin's position as a mainstream asset. The development of robust regulatory frameworks, although still evolving, is also contributing to this stability, reducing perceived risks and encouraging greater participation. As more traditional financial players integrate digital assets into their strategies, the underlying infrastructure supporting cryptocurrencies, such as improved custody solutions and more efficient trading platforms, continues to mature. This environment fosters a self-sustaining cycle where positive price action encourages further adoption, and increased adoption, backed by sound macroeconomic policies, fuels further positive price action. The market is not just reacting to individual news events, but is being driven by a fundamental shift in how digital assets are perceived and integrated into the global financial system. The resilience shown by Bitcoin and other major cryptocurrencies in the face of broader market volatility further validates this trend, positioning 2025 as a year of significant growth and maturation for the entire cryptocurrency ecosystem. The increasing correlation between crypto markets and traditional financial markets, while presenting its own set of risks, also indicates a deeper integration and acceptance of digital assets within the broader economic landscape. While the big picture looks bullish, what happens when the market gets uncertain and investors seek safety? Discover the surprising outperformance of gold-backed cryptos during recent market turmoil. Gold-backed cryptos shine amidst market turmoil. In a striking turn of events that highlights shifting investor sentiment, gold-backed cryptocurrencies have emerged as the top performers amidst recent market turbulence, significantly outshining major digital assets like Bitcoin and Ethereum. As a pervasive risk-off sentiment swept through financial markets, assets traditionally perceived as safe havens saw a notable uptick in demand, and this trend extended robustly into the crypto space. On Monday, spot gold prices climbed by 0.2% to reach $3,372.88 per ounce, briefly touching $3,380. This upward momentum was mirrored by gold-backed tokens such as Tether Gold, XAUT USD, and PAXG, PAXG USD, both of which recorded gains of 0.23% in the preceding 24 hours. These digital representations of gold have collectively delivered impressive returns, accumulating over 28% in gains throughout 2025, closely tracking the performance of physical gold itself. This parallel performance underscores their efficacy as vehicles for exposure to gold's price movements. The contrast with the performance of the broader cryptocurrency market could not be starker. Bitcoin, BTC USD, experienced a decline of 3.23%, while Ethereum, ETH USD, saw a more significant drop of 7.77% over the same period. These downturns not only erased recent gains, but were also exacerbated by cautious commentary from Federal Reserve Chair Jerome Powell at the Jackson Hole Economic Symposium, which injected a dose of uncertainty into the market. The wider stock market also reflected this risk-averse mood, with major indices like the Dow Jones Industrial Average and the S&P 500 closing lower, signaling a broad-based retreat from riskier assets. Gold-backed cryptocurrencies are increasingly being recognized as a more stable alternative to the highly volatile traditional cryptocurrency market. Tokens like Tether Gold and PAXG are directly pegged to the price of physical gold, which is held in secure vaults and serves as the backing asset. This intrinsic link to a tangible, historically stable asset makes them significantly less susceptible to the extreme price swings that often characterize Bitcoin, Ethereum, and other altcoins. As of the latest updates, Tether Gold and PAXG were trading around $3,370.03 and $3,363.24, respectively, demonstrating their close alignment with the prevailing spot gold price. PAXG, issued by Paxos, offers a particularly compelling proposition for investors. It distinguishes itself by not charging any ongoing custody fees for the gold backing the token. This is a significant advantage over traditional gold storage solutions and even some gold ETFs like GLD, which typically impose annual fees that can erode the value of holdings over time, especially for long-term investors. Furthermore, PAX Gold eliminates on-chain transfer fees, granting users the freedom to move their digital gold without incurring additional transactional costs. This zero-fee structure for holding and transferring makes it an attractive option for those seeking to maintain a long-term, cost-efficient exposure to gold. When compared to Tether Gold, which levies a flat 0.25% fee on both buy and sell transactions, PAX Gold presents a more competitive fee structure, particularly for larger transaction volumes. This cost-effectiveness, combined with its direct correlation to gold prices, has been a key driver of its growing adoption. While these gold-backed tokens do not inherently generate yields through mechanisms like staking or lending, the broader crypto ecosystem does offer avenues for yield generation on these assets through platforms like Nexo and uHodler, which have provided annual percentage yields, APYs, ranging from 3–8%. However, engaging with these yield-generating opportunities introduces risks such as counterparty risk on centralized platforms and smart contract vulnerabilities in decentralized finance, DeFi protocols. The resilience of gold-backed tokens during periods of broader market decline reinforces their role as a crucial safe haven asset within the digital asset sphere. As traditional financial markets grapple with volatility and macroeconomic uncertainties, investors are increasingly turning to assets like PAX Gold and Tether Gold for stability. This trend is anticipated to persist as market participants reevaluate their portfolio allocations in response to prevailing economic conditions. Analysts suggest that gold prices are likely to remain robust throughout 2025, which could further enhance the performance of these gold-backed digital assets. But what about the future of the market leaders, Bitcoin and Ethereum, and how are they reacting to economic signals? We're diving into the Fed's rate policy and what it means for crypto's potential rally, along with the hidden risks. Fed policy and crypto, rate cuts could ignite rally, but risks loom. The U.S. Federal Reserve's monetary policy decisions remain a critical determinant of market sentiment and performance across both traditional finance and the burgeoning cryptocurrency sector. Leading on-chain analytics firm Santiment has issued a cautionary note, warning that prolonged high interest rates could potentially stifle liquidity and dampen momentum for major digital assets like Bitcoin and Ethereum. This alert comes at a time when signals from the Fed are being closely scrutinized. Federal Reserve Chair Jerome Powell's recent remarks at the Jackson Hole Symposium hinted at the possibility of future interest rate cuts, a prospect that has buoyed market optimism. However, Santiment's analysis suggests that if borrowing costs remain elevated for an extended period, it could lead to a reduction in the available capital for speculative assets, which are inherently more sensitive to shifts in capital flows. The firm points out that while Bitcoin has been consolidating near the $117,000 mark and Ethereum has been inching closer to its all-time high, on-chain metrics are beginning to signal an increase in selling pressure. This could indicate that significant holders are preparing for potential profit-taking. Santiment's deep dive into social data reveals a heightened level of discussion surrounding the Fed and potential rate cuts following Powell's speech. This surge in narrative concentration on social media platforms, according to the firm's historical analysis, can sometimes precede short-term market tops. Furthermore, sentiment readings for the crypto market dipped to their lowest point since July prior to the recent rally, a pattern that analysts often interpret as a precursor to potential rebounds. The analysis also highlights a tightening correlation between crypto markets and traditional financial markets. For instance, the S&P 500 achieving a new record high, much like Bitcoin and gold, mirrored the market's reaction to Fed policy signals. This growing synchronicity suggests that digital assets are increasingly being viewed and behaving as risk-on instruments, moving in tandem with broader market trends. Coinbase Institutional, engaging in the discussion on X, posed the question of whether Fed rate cuts could indeed trigger a significant breakout in the crypto market. Their perspective suggests that lower interest rates could redirect liquidity from less attractive money market funds into digital assets. However, Santiment reiterates its concern that sustained restrictive policies from the Fed could have the opposite effect, potentially decreasing demand for crypto and amplifying market volatility. This divergence in outlook underscores the uncertainty surrounding the Fed's future actions and their precise impact on digital assets. Market participants are currently divided on the future trajectory. On one hand, projections for Bitcoin to reach $120,000 are often tied to expectations of a dovish Federal Reserve policy, which would include rate cuts. Technical indicators, such as the MACD and Fibonacci retracement levels, suggest that Bitcoin might be in a consolidation phase before a potential upward breakout. On-chain activity also provides some support for a bullish outlook, with evidence of long-term holders continuing to accumulate assets even at elevated price levels and a general easing of selling pressure. However, significant risks remain. The outflows from Bitcoin ETFs, totaling $1.17 billion, serve as a stark reminder of the fragility of the current market conditions. Concurrently, the surge in bond yields is drawing capital away from riskier assets like equities and cryptocurrencies. Concerns about persistent inflationary pressures and the potential for increased tariffs further complicate the economic outlook, reinforcing the view that higher borrowing costs are generally detrimental to risk assets. While some optimistic forecasts suggest Bitcoin could reach $145,000 by 2025, these are contingent on assumptions about continued Fed easing and widespread market adoption, factors that are far from guaranteed. In essence, while the prospect of Fed rate cuts offers a potential tailwind for the crypto market, the current data presents a mixed picture. The interplay between monetary policy, inflation, and investor sentiment creates a complex environment. Investors are advised to remain adaptable, carefully weighing the potential upside against the inherent risks associated with a volatile macroeconomic landscape and evolving regulatory frameworks. We've covered whale movements, institutional trends, safe havens, and Fed policy. What's the final word on these major updates? Get ready for a rapid-fire recap of all today's biggest stories. And that's a wrap on another explosive episode of Bitcoin Bulletin. We saw a massive whale snapping up 200 BTC, signaling strategic accumulation. We explored the powerful macroeconomic tailwinds and institutionalization poised to drive a bullish 2025 cycle. We uncovered how gold-backed cryptos are outperforming amid market turmoil, offering a stable haven. And we analyzed the critical Fed policy signals, with potential rate cuts on the horizon but also lurking risks. Don't miss out on any of these crucial updates. Make sure you're subscribed to Bitcoin Bulletin, hit that notification bell so you never miss a video, smash that like button if you found this valuable, and let us know your thoughts in the comments below. Follow us on all social media platforms for real-time updates. We'll see you in the next one.